In this week's video, we'll examine the question, are cracks finally starting to appear in the bullish case? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. A week ago today on Good Friday, the futures for the S&P 500 had a horrible session. Our game plan coming into the week was to use guideposts to try to minimize the probability of making emotional mistakes. Our plan, as outlined in last week's video, was to remain patient as long as the S&P 500 stayed above 2039 and 2045. All of the levels shown in blue here are still relevant. We'll keep an open mind heading into next week. Before we take a step back and look at the big picture, Dow daily resistance was able to break above resistance during Friday's session. Similar concepts, S&P 500 daily, this line was drawn before Friday's session. We were able to close above it. You can see the moving averages, the common moving averages, the 20, the 40 EMAs, and the 50 and the 200 simple moving averages. We're starting to see a cluster and a turn back up. Typically, this is a good sign. If you're a bull, you would prefer to see the S&P 500 remain above 2100 next week. One more price chart before we go looking for cracks in the foundation. NYSE Composite Stock Index daily resistance, bullish breakout, failed breakout. Two takeaways here. Notice price was typically coming down during bouts of fear to this blue line here. During the last bout of fear made a higher low. We did not come down to this level. We have white space. Here, optimism bounded. We broke out. Both of these are leaning towards the bullish end of the spectrum, at least in the short term. And price was able to recapture this level here. If you're a bull, you would prefer to see a higher high made above this level here. A little bit different take on market breadth this week. Here we're looking at stocks on the NYSE Composite Index. We have advancing volume, so the volume attached to advancers minus the volume attached to declining issues. This is the 2007 October peak in the stock market. The S&P 500 makes a higher high here, and you can see our breadth indicator has a bearish divergence, telling us that the big boys did not participate in this move here in the same level or with the same enthusiasm that they did here in the summer of 2007. We also have the 50-day moving average starting to roll over here in a bearish manner. What is this indicator telling us today? Is it telling us that the institutions or the smart money is running for the exits? This is the same breadth indicator on the same time frame with the same settings and the same 50-day moving average. The S&P 500 has been going sideways here, and the indicator is making a series of higher highs and higher lows. The slope of the 50-day speaks to bullish conviction relative to bearish conviction. It's much stronger here than it is here. The chart in 2015 as of the close on Friday, April 10th, looks a lot better than it did in mid and early October 2007. These are weekly charts of the S&P 500. We still have the whipsaw look here on this time frame, and therefore it can be helpful to review some longer-term weekly moving averages. We zoomed in tight here so you could see the slopes. We have the fastest moving average here in blue on top. We have no bearish moving average crossovers, and the slopes of all of the moving averages are up as of Friday, April 10th. This looks a lot more like this bullish period than this period here in 2007, where the slopes are all down We have bearish moving average crossovers, and the fastest moving average, instead of being on top, is on the bottom. Could this chart morph into something like this? Sure it could, but we don't anticipate that. We wait to see evidence of deterioration. We don't have it on this chart. To help us better understand the answer to the question about cracks in the bullish foundation, we'll look at some other time frames that the market model uses that we do not typically cover in these videos. This is a daily chart here. The concepts are the same. The blue moving average is always the fastest moving average. It's on top here, which is a favorable look. We get the bearish moving average crossover on November 21st, 2007. You can see here the S&P 500 is still trading in the 1400 to 1500 range when we get that bearish look. It eventually bottoms at 666 down here. How do these moving averages look on Friday, April 10th? The answer is much better. This visually gives you some understanding of how we could try to remain patient when the S&P 500 is at the lower end of a trading range and looking vulnerable. Why can we remain patient? This is not a high-risk look. Typically, it takes time to morph from something like this to something like this. If we had something like this when we're near the low end of the range, we really can't be patient, and we have to start cutting risk based on the rules. The blue moving average is the same as the one that we just looked at. These are longer-term daily moving averages, giving us a different perspective. We get a bearish moving average crossover here in early 2008, and we revert back to a full-bore bearish look on July 22nd, 2008. You can see when these warnings, observable evidence starts to surface, the S&P 500 is still trading at relatively high levels. How do these exact same moving averages look in 2015? Much better. Fastest moving average blue on top. The slopes of all of them are up. The market model also answers unbiased and binary questions about weekly charts and weekly moving averages. These are weeklies here. You can see in 2007 we have a bullish trend line here that's broken. That's step one for a trend change. We can see that. Step two is a lower high. This is a lower high relative to this high. And step three is a lower low. Step three came into play when the S&P 500 was still trading in the 1400s. This is where the S&P 500 makes a higher high. This is a divergence with the moving averages, something that we can see. How do these exact same weekly moving averages look in 2015? We haven't broken a trend line, we don't have a lower high, and we don't have a lower low, telling us that this is a much more favorable period for risk than this period here or this period here. Same concepts, we're just using a different set of weekly moving averages and moving out a little bit to look at the chart from a distance here. Here's where we get blue on the bottom here if we zoomed in. Blue is on the top here. This is different. These slopes that are rolling over, that's high risk here. We would have to reduce risk rapidly here due to the visual evidence. Very bad things happened after we could see that. These slopes roll over here in late 2007. This chart goes into 2008. And even from this point here, which is 1260, the market itself dropped an additional 47% after all of this observable evidence was on the charts. Now we're looking at the exact same moving averages on the same time frame. It's very, very difficult to look at these moving averages, their order and their slopes, and say that this looks like a crack in the bullish case. Same concepts, we're just using a different set of weekly moving averages or reference points. Why do we look at multiple moving averages and multiple reference points? It helps us better understand the weight of the evidence. Risk is high when the charts deteriorate on multiple time frames. If we only see deterioration on one time frame or one particular group of moving averages, that's lower risk than when they all come together and start to say the same thing. We can see blue below here, slopes are down, and again here, after these two observable pieces of evidence, very, very bad things happened. As of Friday, April 10th, 2015 at 10:14 a.m., we're still seeing a series of higher lows and higher highs on these moving averages. That's the definition of a bullish trend. Is the VIX showing evidence of increasing fear in the background? The answer is no. This is a bearish trend. This high here in the weekly VIX is lower than this high here. This high here is lower than this high. This is a lower low relative to this low. This is a lower low relative to this low. And this is a lower low made this week relative to this low here. As it sits right now, and obviously the VIX can change quickly, this aligns with the rest of the charts. With all the money printing that's been going on around the globe, it's logical to ask, should we own gold? The market model follows gold. We're always looking at gold from an opportunity cost perspective. This is a weekly chart of gold, GLD, the gold ETF, relative to SPY. This movement here is telling us that the demand or conviction to own the yellow metal is less or lower than the demand or conviction to own growth-oriented stocks. This is clearly a downtrend. The last thing we did, this is a lower high here relative to this high here. This is a lower low here in March of 2015 relative to this low here. We have a full bore bearish look using these moving averages. Price is below both moving averages. Blue is below red, and the slopes of both are down. If gold is the place to be and hyperinflation is around the corner, this chart will not miss it. Gold will begin to outperform SPY, and eventually we'll see our three steps. We'll break a downward sloping trend line, we'll make a higher low, and eventually go on and make a higher high. Happy to own gold if the evidence says that's the place to be, and that may be the case in the coming weeks or months. I'm confident that if you used Google's date search and looked for articles about gold in 2011 here, you could find numerous articles making the bullish case to own gold because hyperinflation was just around the corner. From this point here in 2011, physical gold, this is physical gold, EOD means end of day, it's only priced once a day, has lost somewhere in the neighborhood of 34%. And you can see this is a downtrend as well. How about paper gold? How do the ETFs compare to physical gold? We know this. If paper gold or the ETFs had a problem, the market would sniff it out. And eventually what would happen is the ETFs would diverge from the price of gold, telling you that something's wrong with those paper gold ETFs. Have we seen any divergences between quote-unquote paper gold and physical gold? This is the same chart. We've just added paper gold. This is GLD in blue. It's hard to even see GLD in here because it correlates so strongly with physical gold in red. We've got three lines plotted here, and the fact that it looks like one line for the most part tells us that the market does not believe that there's any problem with paper gold. This is GLD and this is IAU. Why? if there was a problem with paper gold, word would get out. Guys talk, word gets around, you hear things. If and when that happens, we would expect to see these lines start to diverge. So there is a way to monitor paper gold. If you've been using paper gold, you've lost money just like the people in physical gold, which is what you want to have happen. You want it to track it almost tick for tick. And as you can see, that's what happens in the real world. This is a weekly chart of the ACWI ETF, which is a global stock or world stock ETF. World or global tells us that it includes the United States as well as foreign stocks. Resistance, 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 resistance. We broke above those levels this week. When the market model sees something like this, it asks, how does this position compare to the positions that we already own? Is this potentially a better place to be, at least from a probabilistic perspective? To examine that question, the market model has an ETF scoring system that looks at the question from a mathematical perspective, but we can see it from a visual perspective here. This is ACWI, or the ETF that we just looked at, global or world stocks, relative to the VV ETF, which is a U.S. large cap ETF that correlates very strongly with the S&P 500. You can see here we have step one of a bullish breakout in favor of ACWI relative to VV. Step one. Step two is the ratio was able to make a higher low relative to the low prior to the trendline break. Unfortunately for ACWI, in this case, in 2014, step three was never completed. It was unable to make a higher high on a closing basis, and eventually it reversed, telling us that VV was the better place to be. In 2015, it looks a little bit better. Step one, we broke the trend line. Step two, this is a higher low relative to this low here. And in this case, ACWI relative to VV was able to complete step three for a trend change and make a higher high on a weekly closing basis. We also have a full bore bullish look in terms of the moving averages relative to price. What does this tell us? Does this tell us that ACWI will outperform VV in the coming weeks? No. It tells us the probability of ACWI outperforming VV is higher and more favorable for investing here than it was here or here. So chess move A hypothetically could have been selling VV to redeploy the cash via chess move B into something that appears to have a better or more favorable probability of success, and in this case, ACWI for our anecdotal and illustrative example. What is ACWI? It's basically a 50% split between the United States and foreign countries. Why might we be interested in something like this? Because we have hard evidence in hand telling us that diversifying overseas makes some sense here. This is Japan relative to the United States on a weekly chart, has exposure to Japan and ACWI. Switzerland trying to make a turn, has exposure. Germany, exposure. Emerging markets, emerging market here, emerging market here. South Korea relative to the United States trying to make a turn. ACWI gives us some exposure. And China, which went relatively parabolic, and it's difficult for us to buy that, we can diversify and get some exposure to it by using this ETF as a baby step. If the decision to diversify further into foreign stocks, because clients know that we already have some exposure, turns out to be the right thing, we can take additional steps. If some of these breakouts fail, then we've taken only another small incremental step in that direction. This is a weekly chart of the emerging markets going back to 2010. You can see it's been a mess. These lines here were drawn in 2014. If we extend them here with the thinner lines, it paints a little bit of a picture that appears to be bullish. Resistance, 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 bullish breakout. And now it appears that we've come back and retested these basic levels here. And it appears as if EEM has passed. The caveat is we're really still in somewhat of a consolidation pattern here, hence the reason why we still have a relatively small exposure to emerging markets in our portfolios. Another incremental piece of evidence that leans bullish, these are two leading ETFs, HEDJ and TLT. Get a bullish breakout here and what appears to be a successful retest here in favor of HEDJ or stocks relative to bonds. All things being equal, this looks good. Price above, slopes up, blue above red in favor of HEDJ. We like both of these ETFs. This one just looks a little bit more attractive at the present time. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.